All right, listen to me. No, really. Turn up the volume and lean in close. You think you're going to make a fortune because of a hot stock tip on a message board? You think you've got the magic formula to pick winners every single time? Wrong. Let me tell you the gospel truth. The single most important skill in trading isn't picking the next 10-bagger. It's not fancy charting software. It's risk management. Boring, unsexy, absolutely critical, protecting your capital. It's the difference between staying in the game long enough to win and blowing up your account in a week. Boom, gone. All your hard-earned money vanished. I've seen it 1,000 times. Bright-eyed traders arrive, guns blazing. They score a few quick wins, they get cocky, they take bigger and bigger risks. The market is a wild beast. It doesn't care about your feelings or your dreams. It will humble you, and that respect starts and ends with managing your risk. Without risk management, you're gambling. That's a loser's game. I don't coach losers. Think of your trading account as your ship. Your mission is to navigate treacherous market seas to reach shores of profit. Now, are you ready to learn how to do it? Let's get to work. First things first, we need to perform some major surgery on your brain. You have to get your head right before you ever click the buy button. The biggest mistake new traders make is thinking they have to be right all the time. They treat every trade like a personal battle, and a loss feels like a devastating defeat. Get that idea out of your head right now. Even the best traders in the world are wrong 40 to 50% of the time. That's right. They lose almost as often as they win. The difference is, they know how to lose small and win big. They don't let a single loss destroy their confidence or their account. They understand that trading is a game of probabilities, not certainties. You need to start thinking like a casino owner, not a gambler at the blackjack table. The casino knows it will lose individual hands. It doesn't sweat it when someone hits a lucky streak. Why? Because it knows that over thousands of hands, its statistical edge, its house edge, will guarantee a profit. Your risk management strategy is your house edge. You need to accept that losses are a normal, unavoidable part of this business. They are the cost of doing business, like a restaurant paying for ingredients. You have to embrace this. Expect losses. Plan for them. Control them. Now let's talk about how to put that into action. From this day forward, you will stop trying to predict the future. You will stop getting angry or depressed when you take a loss. Instead, you will focus only on what you can control, how much you risk. You will think in probabilities and play the long game. This is where the rubber meets the road. This is the single most powerful tool in your entire risk management arsenal. Get this right, and you're virtually guaranteed to survive. I'm talking about position sizing. It's a simple concept, deciding how much of your money to put into a single trade. And here's the golden rule, the one I want you to tattoo on your brain. Never, ever risk more than 1 to 2% of your total trading capital on any single trade. I don't care how confident you are. I don't care if you think you've found the surest thing since gravity. You follow this rule, no exceptions. Let's break it down. Say you have a $20,000 trading account. A 1% risk means you are not allowed to lose more than $200 on any one trade. A 2% risk means a maximum loss of $400. That's it. This isn't about how much money you buy the stock with. It's about how much you stand to lose if the trade goes south and hits your stop loss. We'll get to that next. This simple rule is your ultimate defense against catastrophe. If you hit a nasty losing streak, and trust me you will, and lose 10 trades in a row, you've only lost 10% of your account. That stings, but it's a flesh wound. If you were risking 10% per trade, you'd be wiped out. Game over. The beauty of this rule is that it forces discipline and removes emotion. When you find a trade setup you like, the first question isn't, how much can I make? The first question is, where is my exit if I'm wrong? And how many shares can I buy to keep my loss at 1%? This calculation dictates your position size. That's your position size. You are risking $200 for a chance to make a profit. You are in complete control. If position sizing is your armor, the stop loss is your eject button. It's the pre-planned exit strategy you use when a trade proves you wrong. A stop loss is an order you place with your broker to automatically sell your position if the price drops to a specific level. Let me be crystal clear. Trading without a stop loss is like flying a fighter jet without an ejection seat. It's financial suicide. You must use a hard stop loss order on every single trade you make. No ifs, ands, or buts. This is not a suggestion. It's a command. Hope is not a strategy. Praying for a stock to come back is a recipe for disaster because it takes the emotion out of taking a loss. Before you even enter the trade, you should identify the price point at which your trade idea is invalidated. Where is the level that proves your analysis was wrong? That's where you set your stop loss. Once you set it, you do not touch it. You don't move it lower because you feel like the stock is about to turn around. That's your weak emotional brain trying to sabotage you. The market doesn't care about your feelings. A disciplined trader honors their stop loss. When it gets hit, the trade is over. You take the small planned loss and move on to the next opportunity. You buy a stock at $100 thinking it's going to $120. You don't set a stop loss. It drops to $95. You think it'll come back. It drops to $90. You start to sweat. It drops to $80. Now you're in full-blown panic mode, but the loss is too big to accept. A stop loss prevents this entire emotional nightmare. It's a circuit breaker that protects you from yourself. Use the stop loss. Respect the stop loss. It is your best friend in the brutal world of trading. Okay, you've learned to control your downside. You're cutting your losses small with position sizing and stop losses. Fantastic. But that's only half the equation. You can have a high win rate and still lose money if your winners are too small compared to your losers. This is where the concept of risk-to-reward ratio comes in, and honestly, it's the engine that will drive your profitability. It's simple math. Before you enter any trade, ask yourself, how much am I risking? And how much do I realistically stand to gain? If the potential reward isn't significantly bigger than the potential risk, you walk away. Pass on the trade. It's not worth it. Your goal? Potential reward at least twice your potential risk. 1 to 2, risk to reward. Example, risk $100 on every trade. You're 1%. If you're aiming for a 1 to 2 risk to reward, your profit target is $200. With this ratio, you only need to be right 34% of the time to break even. Think about that. You can be wrong 2 out of every 3 trades and still not lose money. You can be wrong 2 out of every 3 trades and still not lose money. If you can push your win rate to just 40%, you're a profitable trader. The higher your risk to reward, the lower the win rate you need to be successful. It gives you a massive cushion for being wrong. Here's how you apply it. Before you enter a trade, have 3 prices in mind. Entry price, stop loss price, your risk. Profit target price, your reward. Distance from entry to stop loss, $R. Only take trades where entry to target distance. 2R. Example. Buy at 50, stop loss at 48, risk equal. Sign $2 per share, target equal sign $54. If the math doesn't work, don't take it. You've heard the old saying, don't put all your eggs in one basket. In the world of finance, that's called diversification. And honestly, it's a fundamental pillar of risk management. While day traders might focus on 1 or 2 stocks during a session, if you're holding positions for longer than a day or managing a larger investment portfolio, diversification is absolutely critical. It's the simple idea of spreading your capital across different assets, industries, sectors, to reduce the impact of any single asset performing poorly. If you put all your money into one stock, even a great company, you are exposed to unsystematic risk, company-specific risk. What if that company has a sudden accounting scandal? What if their new product is a total flop? What if a key executive resigns? Boom! The stock could gap down 50% overnight, and your entire portfolio would be decimated. Your stop loss might not even save you in a massive overnight gap down. It's a catastrophic unforced error. But if that stock was only 5% of your total portfolio, the 50% drop would only represent a 2.5% loss to your overall capital. It's painful, but it's not a knockout blow. You can survive that. Diversification is your shield against these black swan events that can come out of nowhere. Now, diversification doesn't just mean buying 20 different tech stocks. That's not true diversification, because if the entire tech sector takes a hit, all your stocks will likely go down together. True diversification means spreading your investments across different non-correlated sectors. Maybe you have some technology, some healthcare, some industrial, some consumer staples, commodities. Think gold, bonds. The idea is that when one sector is struggling, another might be thriving. It smooths out returns and reduces volatility. For active traders, the principle still applies. Don't have all your open swing trades in the same industry. If you're trading 5 different semiconductor stocks, you're not diversified. You're just making a huge concentrated bet on one industry. Instead, maybe have 1 trade in tech, 1 in energy, one in healthcare. This spreads your risk across the market. It reduces your exposure to sector-specific news and allows each trade to play out on its own merits. It's just smart, common-sense risk management that protects you from being overexposed to a single point of failure. Let's talk about leverage, the siren song of the trading world. Your broker offers it to you, dangling the prospect of controlling a huge position with a small amount of capital. It sounds amazing, right? You can amplify your gains. A 2% move in your favor could become a 20% gain in your account. But listen to me, and listen good. Leverage is a double-edged sword forged in fire. It amplifies gains. It amplifies losses at the exact same rate. It is the single fastest way for a new trader to completely and utterly blow up their account. You must treat leverage with extreme caution and deep respect, or it will destroy you. Think of it like this. Leverage is like driving a car. Using a little bit of leverage, like driving at 30 miles per hour, is generally safe and helps you get where you're going. But using maximum leverage, over-leveraging, is like flooring the gas pedal and driving 150 miles per hour through a school zone. The slightest mistake, the smallest bump in the road, and the crash is spectacular and, honestly, fatal. When you're over-leveraged, a small price move against you that would normally be a minor drawdown can trigger a margin call, forcing your broker to liquidate your positions at the worst possible time to cover your losses. Your account is wiped out in an instant. Here's the problem. Leverage makes the math of the 1% rule feel tricky. Let's say you have a $10,000 account. Your broker gives you 4-to-1 leverage, giving you $40,000 in buying power. A novice trader might think, great, I can buy $40,000 worth of stock? Wrong. Your risk capital is still only $10,000. Your 1% risk is still just $100. The buying power is irrelevant to your risk calculation. You must always calculate your position size based on your actual account equity, not your leveraged buying power. My advice for new traders? Don't use leverage, period. For your first year, trade only with the cash in your account. Learn the ropes, prove you can be consistently profitable on a cash-only basis. Talent and intelligence are great, but in the trading arena, discipline is what separates the pros from the amateurs. You can have the best strategy in the world, but if you don't have the discipline to follow it, it's worthless. The market is a battlefield for your emotions. Greed will tempt you to take on too much risk. Fear will make you sell a winner too early or hold a loser too long. Your mission is to build a fortress of rules around yourself to protect your capital from your own worst enemy, you. And that starts with having a written trading plan. It should detail everything: what markets you trade, what setups you look for, your entry rules, your exit rules, your risk management rules. One of the most important is a max loss rule. If I lose 3% of my account in one day, I stop trading. Walk away. The market will be there tomorrow. Another critical aspect of discipline is keeping a detailed trading journal. Every single trade you take, win or lose, should be logged. Record the asset, the entry price, the exit price, the stop loss, the reason for the trade, and your emotional state at the time. At the end of every week, you must review this journal. This isn't optional. This is where the real learning happens. You'll see your patterns. Are you consistently moving your stops? Are your biggest losses coming from impulsive trades? The journal provides objective data on your performance and exposes your weaknesses so you can correct them. Finally, you must fight the urge to overtrade. In this game, you're paid for the quality of your decisions, not the quantity. Sometimes the best trade is no trade at all. This is your Bible for survival and success in the markets. The core message is simple. You must become a master of defense before you can have a winning offense. Protect your account at all costs. Final call to action. Act on this today. Don't just read this. Act. Print it out. Write down your rules. Calculate your 1% risk. Define your stop-loss strategy. Promise you'll never place another trade without a predefined exit plan. Discipline is the price of admission to successful trading. Now go out there and make it happen. Booyah.